So, Palantir has been on an epic run these past few months, and for those that loaded up in the $6 to $9 range like we did right here on this channel for years, we are absolutely loving this rocket ship up. But I know there are many of you guys out there who either missed it, weren't even looking at Palantir at the time, or you took profits when YouTube and Wall Street said to, and now you're looking to build out a position and wondering what is the right way to do exactly that. Well, I'll tell you exactly how to build out a position in Palantir stock starting today, starting from scratch, so that way you avoid all the disasters and all the other stuff that happens to folks who try to play all these little games that are put out there all over the internet in regards to building out a position instead of just going with a solid, tried and true strategy. So let's talk about that today, right after you hit that like button, if you like getting the truth without the hype, because that's what you're going to get today, guys. And a special thank you to all those folks that hit the like button early. I don't think you guys understand exactly how much that helps all of our creators. So please do that for any creator that you like. Hit that like button as early as you can for them. And that's really the best way to support them. All right, so we're going to go over two different ways to buy Palantir stock. You can kind of modify them a little bit too to kind of match your situation a little bit. But as long as you're sticking with these principles, this is the best way to build out a position in any stock. One of them's kind of a beginner, one of them's kind of more advanced. Both of them are highly effective. They've been back tested and everything else in regards to getting you the best average on a great company over time. But in order to execute on these two, you have to do this little short list of things right here. I just want to make sure these are very, very clear, especially for our newer investors out there. You guys got to understand these principles and implement them, more importantly. Otherwise, you're going to screw up the strategy that we're going to talk about today. You're going to fall susceptible to those massive, massive mistakes. So first up, you have to ignore the noise. Look, Alex bangs the table and YouTube and social media and everybody else loses their mind saying Palantir is the worst thing ever. Sell out of it. Some people actually did sell completely out of their position. Even folks that were ultra bullish on the company were kind of questioning the company and questioning Alex and all that sort of stuff. You have to ignore that sort of noise, and you have to ignore the noise to the upside as well, like all the folks telling you it's a screaming deal at $130 per share, $120 per share, whatever the case is. I'm not telling you that it's the worst idea ever to buy at that stage. I'm telling you to ignore the hype and somebody telling you buy it at 130 because it's going to 300 shortly or 500 shortly or 200 shortly or whatever the case is, or there's a super short squeeze, blah, blah, blah coming. That's what I mean by ignore that sort of noise. That is not investing, that is speculating, that is gambling, and that routinely loses over the long run. It is not a good way to invest. Next up, do your due diligence. Now, I understand this can go for a long time, and I'm not going to give you guys a rehash of an entire do your due diligence type scenario and how to do it and all that good stuff like that. But if you don't do due diligence, you don't know what you own. You don't know if that earnings blip is a problem, fundamental change, something wrong with the business, or if it's something that's just a one-time expense, maybe it's cyclical in nature. Whatever the case is, you'll know that, hey, that dip is a massive opportunity and not Wall Street sees a problem and there's bigger things coming. You can't understand that. You can't know that if you don't do your due diligence. So you have to do your due diligence and understand the company, understand the management team, understand how they move, understand how they talk, what they talk, do they deliver on their promises. Everything else of that nature all goes into your due diligence. You have to do it. And finally, we have earnings performance. Go back, review the earnings calls, review the actual filings, review everything in regards to their earnings performance. Don't view hits or misses. I could care less. That's Wall Street's expectations. Do they hit their own? Do they say, hey, we're guiding to X amount of EPS, and then do they actually hit and perform to X amount of EPS? Do they routinely beat and raise their guidance, or do they routinely adjust their guidance down? Those are all clues into what's going on and what their actual performance is on earnings. Whether they hit or miss or not is completely irrelevant and doesn't tell me a whole heck of a lot about earnings outside of the fact they might not be meeting Wall Street's expectations. I don't care about Wall Street's expectations. I care about their meeting their own goals, their own targets, because that's what I'm basing my investing decisions on. Not on what Wall Street thinks or what Wall Street wants, but based upon what guidance the management team has told me they're going to hit. Do they deliver on that guidance and the earnings, of course? And then more importantly, are they routinely able to accurately forecast that business? And of course, you can see on the flip side there, are they routinely forecasting one thing and then having to revise down because they can't hit it? Again, another thing that shows you whether a company is performing or not on earnings. So those are kind of some big hitter things that you got to understand before you do these next two. So we'll start off with the easy one, and then we'll go into the more complex one there. Definitely not for newer investors, but if you have some experience investing and you're comfortable with price targets and everything else, you can absolutely do the number two. So the first one is just do a simple DCA. And guys, DCA, dollar cost averaging, means you just basically set it on a schedule and you move on. So every paycheck, you're going to buy $200 worth of Palantir. And so therefore, every paycheck you execute and buy $200, $500, $1,000 worth of Palantir, whatever it is, you just buy it. Doesn't matter what the price is. Your paycheck hits, that money gets allocated out, and you buy on that schedule and you move on with life. Statistically, this is incredibly hard to beat. They've done all kinds of studies. We did studies within my group as well, back testing all this sort of stuff. Even Goldman Sachs and other big banks have done studies on this as well. And it's very, very, very hard to beat a simple DCA into a stock because you just end up buying it when it's high. You end up buying it when it's low. And as we talk about all the time here on this channel, what matters most is share count. Yes, that means you own some overvalued shares. Absolutely means you can own some undervalued shares as well, because you're basically buying all things, the ups, the downs, whatever the case is, you're buying regardless, because you know if you want to own Palantir and you feel Palantir in 20 years is going to be the biggest company in the world, well, guess what? It's going to be really, really, really cheap, even at today's price today, based upon that future, if you think that's their future. So having every single share that you can, regardless of whether it's 60 or 130 or 6, of course, you'd much rather have those $6 shares, but we're not there anymore. That's not our reality anymore. You've got to deal with today. And if you feel like that future is the largest company in the world or one of the largest companies in the world, well, guess what? That means today the share price is really, really cheap regardless. And the easiest way to avoid all the headache, all the stress, all the ups and downs and tracking and everything else of that nature is just simply do a DCA and move on with life. And the second strategy is to do a modified DCA. Now, this is the one that I personally do because I do feel like you can get a little bit of alpha here, especially if you understand valuation and obviously you understand investing on a very, very high level. We've actually back tested this one as well. Trips, our coach there in the group, actually went back and did it, and you can actually beat a DCA by simply doing a modified DCA, which is a DCA except for whenever the price gets extremely overvalued like it is right now. I'm not buying the stock personally. And then whenever it gets undervalued, I increase my DCA amount. And of course, as it continues to fall lower and lower and lower below fair value, you increase that DCA amount even more. So essentially at a time like right now, I'm not buying any shares. However, let's say it dips down to where my price target is. At that stage, I'll start my DCA. And as long as it stays around my price target or falls below my price target, I'll continue to buy shares on a DCA schedule like we just discussed. And then if it happens to really fall down lower, let's just say, I don't know, it falls all the way down to 30 bucks or something crazy like that. Well, at that stage, I will actually increase my DCA to a higher amount and keep right on moving forward with that higher amount, therefore buying higher amounts of those lower price shares. How did I get the money to buy those lower amounts? Well, whenever it got overvalued like it is right now, I'm simply stacking back that cash or lowering my DCA amount. That's a perfectly viable strategy too. You're going to DCA all the way through, but whenever it gets overvalued, you're going to buy less shares. And then whenever it's and save that money for whenever it gets undervalued, then you're going to buy more shares at that stage. Not only because the price is cheaper, but because you're going to put more money towards it as well whenever it hits that undervalued shares. Doing either a DCA or a modified DCA to me is the only way to buy Palantir stock, especially after this run up and at this particular stage. Now, if you're more confident in price targets like I am, and you're patient and you can wait and you're willing to accept the risk that comes with waiting, then you absolutely can do that as well. But that is an advanced strategy and you have to understand what you're doing. I'm more than willing to wait, but I also own more Palantir than I ever wanted because we were just gobbling so many cheap shares for more than a year that heck, we were even able to buy last year in the 20s. So for me, I own way more Palantir than I need. So I'm willing to wait for super duper discounts. But if you can't wait or you're looking to build off that position and you may never get a super duper discount like I'm looking for, then at that stage, these two strategies are the best strategies I would personally use to start a position in Palantir stock. And if you want a complete breakdown of how to do due diligence on a stock, how to actually set price targets, how to get that extra alpha out of your investing that we just talked about. If you stuck around this long, I may have left something special down at the pinned comment for you down there where you get all that through 5 free courses, free coaching. You get direct access to me anytime you want. See all my buy and sell alerts in real time. Get to see my complete watch list of price targets. We got bull and bear cases on multiple stocks in there as well. Guys, there's so much involved. Make sure you check out the pinned comment, see if a membership's right for you. And click this video here if you want to see exactly what I'm buying in this market. And click here to see my exact plan for this market. So thanks for watching, and we'll see you in the next one.